Hi, I'm Andrew Comstock with Beyond Wealth, and this is our first quarter for 2021 viewpoint, which is our review and outlook for the first quarter and the rest of the full year here in 2021. So we're going to start off with what was another good quarter for stocks. We have had something called the everything rally is something we've been using the term to describe it. And we've seen pretty much all asset classes, with the exception of one or two, and we'll get to those in a minute, have done very well again this year. So stocks across the board have done well. You've had the meme stock craze, so GameStop and AMC. Cryptocurrencies have done well, and most commodities, oil, and then other things that go into stuff such as copper and aluminum have also done strong this year. The one thing that we have seen jump off the rally train have been bonds. And when you look at bonds, generally speaking, as interest rates go up, bond prices go down, and we saw a pretty significant increase relative on a relative basis this quarter when it comes to interest rates. So let's look at some numbers. So the first quarter performance, what stands out here is how well small cap companies did. And that's that orange line, and that's the Russell 2000, up almost 13% for the quarter. When the economy is poised to do well or is doing well, or in recovery mode, smaller companies tend to benefit. And that's one of the reasons why we're seeing them accelerate here. Across the board, you can see positive rates of return with the exceptions of bonds. Bonds off about 3.4% for the quarter. But we'll show you a slide here in a second with the 10-year treasury rate. The performance since the COVID low. So if we go back and we pick March 23rd of 2020, last year, we can see that virtually all asset classes have surged again, with the exception of bonds. Small cap companies up 124%. Technology companies represented by the NASDAQ up about 95%. And you can see the Dow, the S&P, and international all have done very well and have recovered and then some since the lows of last year. Now let's talk about interest rates real quick. So the chart on the left is going to be essentially year-to-date 10-year treasury, and you can see we started the year at about 0.93%, so just under 1%, and we're at about 1.74% at the end of the quarter. Now, relative speaking, pretty big move. If you look at the chart on the right, though, you can see that in the grand scheme of things, I mean, rates are still quite low, but they have moved significantly up. But we're still actually, believe it or not, below where we were at the beginning of 2020. So this is a big reason why we started to see a sell-off in bond prices, as we finally have seen interest rates start to move up a little bit. And we'll talk about that some more in our outlook. What we want to talk about is kind of a market transition that we saw this quarter, and that was really since 2015, growth stocks have been leading the market by a long shot. But this quarter, we really saw for the first time value take a pretty substantial lead versus growth, or it appears the baton, or the market leadership baton, has been handed from growth stocks to value stocks. Now, the blue line is going to be small value. The orange line is going to be large cap value. And then the purple line is large cap growth, and the green line is small cap growth. And so in general, you can see value has had to outperform significantly across the board. Why is that? So anytime you start to see rates rising, that generally is a good thing for a good thing for value companies relative to growth. Two reasons why. Companies that make up that sector, the value sector, generally are financials, generally industrials, and they are things that respond better when we have a little bit of inflation and a little bit of rising rates, or rising rates in general. Growth companies tend to be ones with higher valuations. Anytime you see a stock with a higher PE or higher enterprise value to EBITDA, generally speaking, as rates go up, it's a little bit more difficult environment for them to maintain those same valuation metrics. So a company that was trading for 30 times may be now valued at 28 or 27 times. So not major changes, but subtle changes along the way there. So that's the big thing there in terms of kind of what happened in the past quarter. I think when it comes to our investment strategy, this is the exact same slide that we used in December for our strategy. Nothing has changed there. So we are fully invested. We are overweight stocks. We are underweight cash and bonds. Simple point is we think stocks are going to be a better bet for us, moving forward. But at some point we probably will go back to maybe a neutral status. But for the time being, we are very much focused on being overweight stocks. We are diversified across the board. We like value, low volatility, and international. And we're not overweight growth at this time. We're just kind of more or less neutral on growth stocks. So this strategy has done well in this first quarter. It's been a good positioning for us, and we are going to maintain it for now, but as always, monitoring things as they go about. In terms of the outlook, the rest of 2021 is going to be a really fascinating year on a lot of fronts. The first thing, the U.S. economy is going to rip this year, and we have a potential to have, if you look at Goldman Sachs's some research they've put out, they expect us to have an 8% economic growth this year. We haven't seen growth that robust since 1951. So it gets the fire emoji on this one for me. And, big reason why is we've had a couple of rounds of fiscal stimulus that have hit the economy, now working its way into, kind of regular activity. The vaccine rollout was off to a slow start, but I think at this point, it's moving better than any of us really could have hoped. Is by May 1st, we should have pretty much anybody in the country who wants a vaccine should have access to it pretty quickly. That's great for getting people out and spending and consuming. Speaking of consumption, the consumer's in the best shape they've ever been. Their savings accounts are flush with money. Many people have received stimulus checks, and mostly people are ready to go out and do something different than what they've done for the past year. So they want to travel, they want to go out to restaurants, they want to see friends, and so I think that's going to be a major catalyst for the economy. Now, a lot of people think you've talked about being optimistic but realistic when it comes to stocks, kind of in your investment strategy section. Why don't you think because the economy is going to rip, the stock market's going to rip? Something that we've talked about in the past is whenever we see the stock market's a forward-looking mechanism. So part of the reason why we had the robust gains that we had off the COVID lows was in anticipation of what we expect to have happen in 2020. So the gains in 2020 in the stock market were largely because of the expectations of a good economic activity in 2021. Stocks are probably more so trying to discount what's happening in 2022 and beyond at this point. So that's a big reason why. We're very positive on both things this year, but we think that the economy is going to significantly outperform the stock market this year. In terms of interest rates, we've got an interesting poll going on right now. Is the Federal Reserve, they set short-term rates in the United States. And so those are things like what we get paid in our savings accounts at a bank. And then the bond market generally is the one who dictates what anything beyond a few years at. So 3, 5, 10, 30 years is generally speaking what the bond market tries to set the rates at. And so you've got a kind of a pull going on right now. Is that the short-term rates that the Fed has set, we are not going to raise rates for several years. We are going to let the economy run hot. We are going to let inflation go above our 2% target because we want to get the economy back to full employment. And there's many reasons why they want to do that. But it's partially to kind of fix what's happened with COVID. And part of it is also to make sure that everybody can participate in the economy. So it's a far broader reach than we've ever seen the Fed have in the past. So they're keeping rates essentially at zero, where the bond market we've seen has gone from just under 1% to almost 1.75% just this year. And so this poll is going to be interesting is because generally speaking, we anticipate rates will probably continue to creep up higher. We probably won't see another, be a 2 or 2.5 or 3% at the end of this year, but we do expect them to kind of creep higher throughout the rest of the year. And it's going to be interesting to watch to see how the Fed reacts to that. And the reason why interest rates are moving is partially because of expected inflation coming down the pike, also just because the economy is doing well. And so if the Fed, for some reason, decides they need to take action and raise interest rates in 2021 or 2022, that could be an interesting thing. And that could create a lot of volatility for the markets, particularly stocks and also bonds because they'd be deviating from policy that they've been firm on for many, many years. So we're optimistic on stocks, but we are realistic about the returns this year. So in terms of stocks, the buybacks are going to be back with a vengeance. We think now companies are free to buy back their shares. That's supportive for stocks. The economy, as we've talked about, is very good. And we also expect there to be very good earnings growth off of what was a pretty easy comparison from previous years because of COVID. So all those things are positive. On the flip side, what are we a little bit nervous about? Valuations are rich. So we're trading at about 22 times 2021 earnings expectations. And so that's above average. That is well above average. And I think if we see companies outperform their expectations, that'll be good, and that should allow us to keep that multiple. But it's something that we're mindful of and watching. The other thing is we've had Robinhood traders or retail investors surge into the markets partially as a hobby or as an activity during COVID. What happens when they get to go back to their normal activities? So they go out to movies, concerts, restaurants, hanging out with friends, being around people, traveling, and they no longer do this because it's not quite as fun a hobby when they've got other options. When you lose that investment dollars in the market, it could cause a slight pullback, or we could experience maybe a slight pullback because of that. Now, not a major sell-off at all, not what we're expecting, but when we lose those future investment dollars coming into the market, it could cause a period maybe when we experience maybe a sideways move or potential pullback there. The last thing we're going to chat about is fiscal stimulus or future fiscal stimulus and taxes. So I think with this, this is going to be probably the biggest thing that we're going to be chatting about, and activity is probably going to be pretty slow on this one. So the first one, at the end of the quarter, so in late March, the Biden administration announced almost a $2 trillion or over $2 trillion infrastructure plan that was pretty broad scope, but looking to fix roads, bridges, communication, a little bit in early childhood education, elder care, and a few other areas. But this is something that I think a lot of people wanted to see is fiscal response, not just monetary policy response that the Fed has done. And we've gotten it the last 2 years. And this is the first one that infrastructure, if you've heard any TV show, they always make Infrastructure Week jokes. And we actually have finally got a infrastructure policy out there. Now, to pay for this, there is essentially a tax increase potentially coming. Nothing is being set yet. It's all just proposals. It's all in the discussion phases. But the first thing they want to do is increase corporate tax rates, which now are at 21% to 28%. That's what the Biden administration is looking at. Before we get the Trump tax cuts in 2018, corporate tax rates were at 35%. So again, it's not going back to where we were, but it is probably a halfway step there. What we're reading right now is that most people are projecting tax increases are coming on the corporate side, but probably a compromise will be reached somewhere around 25%. So not it's a halfway step again on that one. The other thing we are expecting is that for the highest income folks right now, it looks like about $400,000 for household income. They could potentially see a return to a higher tax rate or a new bracket essentially added for them. Again, all preliminary discussion, but those two things are going to be market moving events that we'll have to monitor as we go out throughout this year. So the economy right now is well lubed with a lot of stimulus, and this infrastructure bill really is more so focused on things that are going to happen 18 months to 10 years from now. So it's going to make sure that the economic growth that we're seeing now is sustained for a while. That's how we'll kind of leave things at this point. So we're constructive on stocks. We think that things are going to be very good on the economic front. We are underweight bonds for the time being, but again, a lot of the damage we think has been done, and it's been about a 3% sell-off, so nothing major there. A bad bond market is far different than a bad stock market. And on that, we will end this quarter's U.S. Review and Outlook. Go check out our blog. We've written this out in about a 2-page summary. So if you'd like to read it there, you're more than welcome, and sign up for our newsletter.